Welcome. We want to thank you all for coming out tonight. My name is Tasha Bay here on this Wednesday night with everybody, and I hope that everybody has had a fabulous day. It's been a little rainy here, but the sun is still shining, right? We're still able to come together and connect and build with one another and share some great information. So, for each of you that are here this evening, I want to give a hearty welcome. And I will not waste a moment's time letting you guys know who is about to come before you. She is absolutely an amazing lady that I have had the privilege of knowing for almost 10 years now. Had the opportunity to work with her in multiple business opportunities. And she's been amazing every single time. Like on another day and another time, I'll tell you the actual story. Kind of funny, but needless to say, Thierrie Patterson is absolutely amazing at everything that she lays her hands to. And because of that, it's been one of the reasons that I've had no problem working with her in business over the years. She absolutely is extremely intelligent. Right. She is very well educated. And when it comes to the subject matter that she's going to present to you tonight, I think that you will be very glad that you made space in your calendar to be here this evening. So without any further ado, I give you now Ms. Terry Patterson.
Thank you for that, Tasha. Good evening, everyone. I definitely appreciate those kind words, and I also appreciate all of you all that took time out tonight to be on because you guys could have been anywhere else, but you decided to be on here with us tonight. And so I am going to share my screen, talk a little bit tonight about life insurance. And so, that's usually like a word that gets a lot of taboo. A lot of times when we hear life insurance, we get to a place where we're kind of like, oh my goodness, um, what's this really about? Is it something that we really need? Is it something that, you know, like I guess I'll say this. Some people kind of feel like if you talk about it, you're like jinxing yourself. But you got to understand, though one could look at it like that. To be honest, if you don't talk about it and you don't prepare properly, you're doing yourself and your family a disservice. And so just really quickly, a little bit about myself. I've been in this industry now, and it's kind of crazy when I'm thinking about calculating the dates. I will have been licensed for almost 7 years, come towards the end of this year, and that's kind of crazy. But before all of that, life insurance wasn't even something I was really thinking about. And that's just crazy to think about today. At the time, when I was first introduced or even started thinking about it, I had 4 children. Now I have 7, but I had 4 children, no life insurance, was working my job in the medical field. And to me, now I know I was playing a game of risk because if anything would have happened, I don't know what would have happened to my family. And so, thankfully, I got educated on some different things. I got educated on how finances really work, what goes into all of that, and I decided to be in the industry, but also be able to educate others because I felt like I was in a lot of people's shoes, just not knowing things. And so tonight we're going to talk about protecting the bag. And it comes in different forms because you want to protect your money, but you also want to protect yourself, your legacy. We're going to talk about more things, but tonight, like I said in this slide, you can see protect what you build, grow with confidence, and position yourself for long-term wealth. And so as we are looking at this topic, most people really focus on making money, but never really create a strategy to protect it. And so there's about 102 million Americans that are uninsured or underinsured. And so really a third of adults have inadequate protection. So 1 out of 3 people you pass by doesn't have the proper protection, whether or not it's the amount or maybe even the type. And if you look at numbers too, about 30% of Americans would face financial hardship within 1 month after the unexpected death of a wage earner. That's a lot of individuals that are going to be left stuck and stranded. I don't know if you guys saw recently within the past probably 4 to 3 months, there was a couple celebrities that passed away, and even their families were talking about the financial strain that they were going to be going through because of their loss. Um, so What would happen tomorrow if your income stopped? I want you to think about that for a little bit. Which of these things would be the most impacted if your income stopped tomorrow? Would it be your mortgage? Would it be your family? Would it be your child's education? Would it be your lifestyle? Would it be debt? Would it be your health and your well being? Because a lot of times we think about things, um, we don't really plan for the future. So we don't think about if my income stopped today, what is the most impacted area of my life? Because that's something we all have to think about. Um, so I'll let you simmer on that for a second. But that's something that is a question, you might not have the answer right now, but it's something that you need to really, really think about it. So, life insurance, not all life insurance is about death. Most life insurance is about life. And so that's why it's there to protect what matters the most. It can be there to protect your income. It can be there to protect your family. It can be there to protect your legacy, different opportunities. And most of all, typically, it's going to give you a peace of mind that you have something in place for when life happens to you. And so, what are you really protecting? Because it's more than just a policy. You're able to protect your income. You're able to protect your children and your children's futures. You're able to protect your home, your business. You're able to protect your retirement, legacy, lifestyle, and your future. And so, when you think about this, when you're getting life insurance, and we're going to talk about different types of policies, but based off the policy that you get, you're actually putting protection in place for many different things in your life that are going to have an impact typically in the future. Some of them are right now, but that is what's really being protected through life insurance. And so there are five types of life insurance, but I decided to break them into four categories. So we're going to talk about them in four different categories, and each type of policy is going to serve a different purpose. And so understanding the basics of these is going to help you to understand how they all work. Do I need one or the other? Do I only have one? Am I in the right one? And so the first one we have is term life. Term life insurance is kind of temporary protection. You only have protection for a set amount of time. It could be 10 years, 15, 20, 25, 30. It's typically the most affordable, and it's really, really good for income protection and also protecting most people's largest asset, which is their home. So that is what term life is. Then we have whole life. Whole life is going to be a permanent coverage. You're going to have lifelong protection. The premiums are going to be fixed. It's going to build cash value. So that's one of the things with whole life. Then we have universal. Universal life is going to be a flexible, permanent strategy. You're going to have permanent coverage. It's going to be flexible in structure, and you have the potential to grow cash value within universal life as well. And then you have final expense. Final expense is going to be the end of life protection. These policies are going to be smaller. They're going to usually cover funeral expenses, maybe, something that would be immediate that the family might need. And it's usually easier on underwriting. So typically, sometimes if there's a lot of medical conditions or things that are going on, you usually can get a final expense type of policy. But like I said, we're going to go deeper in all four of these. So I'm going to talk about them a little bit deeper and also the pros and cons of each one. And so let's go back to term life. Term life insurance is protection for a season. Like I said, number one, it is very affordable. It's lower cost than most other coverages. You're also able to get a higher amount of coverage. So I'm going to ask a question just because I said that. Typically, on average, when you're thinking about term life, does any of the guests know how much insurance should you have multiplied by your income? How many years of coverage should you have in place that would equal your income or even including all your expenses? Because that's a number that we usually run with individuals, and we find out a lot of people don't really know that number. And so I'll just wait a second. But typically on average, one person said 1.5, one said 7 times. Um, 1.5, can't even try to front and say close. That's not close. 7 is definitely closer. But typically on average, people want to have between at least 10 to 12 times the coverage that they have for their income and their expenses. And so with term being very affordable, it allows somebody to have that higher amount of coverage that's going to protect things like replacing your income, helping cover a mortgage. So that's why you need that much. So just a quick rule of thumb, if you just took your income alone times your annual income 10 to 12, that's at least how much coverage and insurable need that you have. So for a lot of people, it's more than what they're thinking, more than what they thought they needed. Three, term insurance is usually very simple to understand. It's, hey, I'm going to get this policy for 25 years. This is what it's going to cost. This is the amount that I get. That's what it is. Now, you can pick different ranges of terms. So, like I said earlier, it can be 10 years up to 30 years. I'm going to talk about the other part on the con side or the next page. But one thing, too, about term, there are term policies that actually have living benefits. So, typically with term, there is no cash value. You can't pull money out. But if you have a policy that has living benefits, if you become critically ill, chronically ill, or have a terminal illness, you are allowed to accelerate that death benefit and actually use it while you're still alive. So that's something very, very powerful that you can have with term coverage. And so not every policy has this. So you definitely want to make sure you reach back out, or even if you have term right now and you don't know if your policy has this, definitely get a second set of eyes on it to see, hey, if something happened to me and I could not work, do I have access to my money? You might or you might not. So definitely reach out and see if that fits in with what you have going on. Now let's look at the pros and cons of term insurance. So with term insurance, some of the pros, like I've said, super affordable. You can get high amounts of coverage, simple to understand, great for young families. You can have income and mortgage protection, and living benefits are included with the right provider. Some cons, though. The coverage is only temporary. So it's only supposed to cover you for a period of your life. It's going to expire when that term is over. There's no guaranteed cash value growing in this policy. Typically, it's going to increase with age. So if you wait, you could get a policy at 30 years old, but you say, hey, nah, not right now, I'll get it when I'm 40 because you're older, it's going to cost a little bit more. We're going to talk about that later. And then two, some policies, they'll say, hey, you can get this for 30 years, but there's going to be a renewable portion. So after year 30, you could still have coverage if you renew. But the thing here that most people don't say, when you renew in those years, typically your cost of insurance is going to be a lot more expensive. And when I say a lot, I'm talking you can be going from paying $50 a month. And when it gets to that renewal point, your premium might turn into be $700. Like it is a lot more money if you get to the renewal period. So we try to avoid that at all costs. But there's definitely a time and a place that term makes sense that everyone should have if they can qualify for it. And so now moving on to the next type of insurance, we're talking about whole life. Whole life is, like I said, it's going to last your whole entire lifetime. Most people are using this, designing it for legacy. And so it provides lifetime protection as long as the premiums are paid. And you're going to get a cash value component and it will grow over time. And so some things about whole life, it's guaranteed for life. Cash value will grow in this policy. It's going to be typically on average, but you're going to get a 3 to 5% rate of growth on these policies. So that's how you're going to look at that cash value side. There's tax advantages to that. The cash value is going to grow tax deferred, and you can take your money out tax free, depending on how you want to utilize it. And also, because cash value is growing, you have the ability to pull it out and use it for different emergencies or different opportunities. And so there's a lot of individuals. I don't know how many people you guys talk to on a average basis on life insurance, and especially whole life. I know quite a few people that I've sat down with and talked to, and they've had whole life policies where they've actually pulled out cash value for whatever they might have needed. And so that's something that whole life has going for it. Now, there's still some pros and some cons to this policy. And so we kind of talked about a lot of the pros. One of the ones that legacy planning, I guess, is kind of the biggest one I didn't talk about. But the other things we talked about: lifetime coverage, cash value, fixed premiums, financial stability. But on the flip side of whole life, it's going to cost more because you're now paying for your whole entire life of coverage. It's not just a specific period like term, so it has a higher cost. In the beginning years, cash value tends to grow a little bit slower. There's not a lot of flexibility compared to some other products. There's a lower immediate coverage per dollar, um, and it's a long-term commitment. And so those are some things to think about when considering whole life. Now, if we were to think about universal life um, is still permanent, but it has flexible aspects to it. So the premiums in universal life are flexible, and you can adjust the death benefits. So it makes this policy. So basically, the difference when you think about whole life, it's more. My mind just went blank. It's more a level, like you're gonna pay something, it's not flexible, but Universal is gonna have flexible aspects to it. So that's kind of how you think about these. And so, like I said, flexible premiums, sometimes maybe you might start your policy off at, it might start off at $200 a month. You might get a big bonus and say, hey, I want to put another 500 in there. Or life might have hit you this month and I can only afford 50. So just depending on how it's designed, those are possibilities with your universal products. There's an adjustable death benefit that could be adjusted or increased or decreased just depending on your needs. You do have the ability to grow cash value in this product, and just the overall flexibility of this plan is really what makes it very powerful. Now, the thing about universal life, though, it has three different options. And so sometimes you'll hear people talk about universal, but you have to know which one. There's actually something called universal life, which is just UL. You have index universal life, and you have variable universal life. And so what these things are representing, the index, the variable, or just the plain, is how the cash value component is growing in this account. That is what's different from all of these. In universal life, um, basically you're going to grow at a specific rate. And so that's something that makes this policy very similar to whole life, but it has a lot of flexibility. But it will grow usually at a declared interest rate. Um, and other than that, it has all that flexibility. Then you have the index policy. It's still flexible, but now it's not in the market, the money that's growing, but it's mirroring the market. So you get to mirror the market, take the gains of the market, but at the same time, IULs have a floor, so you never lose money with the market. You just are mirroring it, taking the gains, not taking the losses. And then you have a VUL. A VUL is a variable universal life. This one actually does put your money in the market. So if the market is up, your money is up. If the market is down, your money is down. This is better for those that are comfortable with more investment risk. So that's kind of how you look at all of that, which I know it can be confusing, but I just kind of wanted to make sure everybody understood there's multiple options of universal for sure. Now, when we look at these, going Okay, pros and cons. I was like, wait a minute, where'd that slide go? They're all flexible. Universal is definitely permanent coverage. It's straightforward with the cash value. That's what it has working for it. It has the most modest growth typically. The policy still has to be funded properly. There's less upside linked to these accounts. Index universal life, it's linked to the market. The market's going up, your money's going up. You don't have to worry about the risk of being in the market. They are more complex to understand. Now, there can be caps on some growth, there's some that there's not, and your performance is not guaranteed. And then with the variable, it has the highest growth potential because of the market. Flexible, but because it can grow the most, it also has higher risk. And, your cash value can go down. So you just have to make sure you're actively monitoring this type of account. And now let's look at the last type, which is final expense. Final expense um, is basically, like I said earlier, a smaller amount of permanent life insurance that's usually used for funeral costs, burial expenses, and other end of life bills. And so, these policies typically on average go up to 50,000. One of our providers now is going up to 100,000, but usually it's up to 50. So people are usually getting anywhere between 10, 25, $50,000 with these accounts. Like it says, it's helping to cover the cost of funerals. The underwriting is easier. So typically for older individuals that might have health concerns, this is usually a good option for them. And it just helps the family give you peace of mind, knowing when I pass, this is what I have set aside specifically for final expense. And like it says right here, it's a benefit for seniors, people that have funeral or burial planning needs. Families want to ease of end of life expenses and simple permanent coverage. Um, there's a couple different options that we also work with and have some that have funeral concierge, some that have a lot of extra added benefits. So that if that's something that you are interested in, definitely want to have a conversation and see what all we have to offer. Now, looking at the pros and the cons, pretty much we've talked about all the pros to this policy. But when we look at the cons of it, it's smaller amount of coverage. So this is not something that like, hey, I'm trying to leave a legacy for my family. This is not the product for that. It's not designed to replace your income. It can kind of seem a little bit more expensive, especially if you're comparing it to like a term. There's very limited cash value because that's not the focus of this product. And so it's really just to address the final needs of the individual. So there's not a lot that you're wanting to do with this product. But when we look at um, who these different types of insurance can benefit. Term, like I said earlier, it could be for young families. Term is going to help protect your income, mortgage protection, those that are budget conscious and just need some type of coverage because I believe something is better than nothing. So some type of coverage. Whole life could be good for people wanting lifetime coverage, people who value stability and fixed premiums, legacy minded individuals, conservative long-term planners. Universal life, people who want permanent coverage, but they want to have flexibility. They want to be able to adjust things as they need, and they know that they're going to want some long-term planning structure. Index universal life, those that are interested in having index growth. They want to see accumulation, but they also want protection because also a lot of index universal life products, they still have living benefits in them as well. So that is a huge plus for them. And then when you look at variable universal life, these are for people that are comfortable with market risk. They want to be able to have a greater potential to grow their money, and they do like to actively monitor performance. Final expense, like I said, it's typically better for those that are older and they're trying to get coverage. Maybe they can't. Now, I will say, even though I've kind of said older, I still have final expense for my children as well. So it doesn't just mean you have to be older to get this product. Everybody can have this product. This is just specifically, like I said, for like your funeral expenses, but typically because underwriting is easier, those that are older that might have more ailments and things happening, it's easier for them to qualify for this. And so, you know, the myths. So I've kind of explained different types of insurance and how it works, but I want to talk about five different things though that a lot of people hear or say that are misconceptions that cost people protection, protection of their money and peace of mind because they've heard these things and think that, hey, if this is what's going on, I'm good. Well, that's not always the case. The first myth that we hear people talk about is life insurance is just too expensive. And really, 72% of people overestimate the cost of basic life insurance. If that was you, put a one in the chat for me because sometimes we think it's going to cost so much. So we put ourselves in a position to be like, hey, I don't think I can afford this. But then, really, once you start seeing the numbers, you're like, wait a minute, that's all that it is? Okay, I should have did this a long time ago. And so yeah, we have a few ones in there, and so that's the thing. It is definitely for more people. It's less than monthly subscriptions that can protect your family, your income, and your future. And guys, I don't always like to compare it to car insurance, but you pay so much money for car insurance for a piece of metal. You could pay a fraction of that for yourself, your life, your family. You are worth more than your vehicle. And we're mandated to pay car insurance, but I just want you to kind of think about that. We need to make sure we have protection for ourselves as well. And typically, and I have another slide coming up that's going to kind of talk about the cost, but it is not as expensive as most people really think it is. Here, right here, oh, I'll just get it later. I'm too young. What do you mean too young? Why are you too young to basically put a value, not the true value, but carry a value on your life? Because when you think about it, the younger you are, typically, that's the healthiest you're going to be. The older we get, we start having ailments, we start having things happen to us. And so the earlier, the better. You can lock in that rate while you're young and healthy. Life can happen at the blink of an eye. I have a client, super healthy. All of a sudden, one day, had a stroke. That changes whether or not that individual can ever get life insurance again, potentially. And then just the cost of waiting. It's just going to be more expensive for the same coverage. And here's an example: $500,000 of term coverage at 25, $28. 35, 10 years later, we bumped up $12, y'all. Now it's $40 a month, which is still relatively still inexpensive. But now if we wait 10 more years, it's $74 a month. So that time does cost you. So don't think, oh, I don't need it right now. But at the same time, so many things can happen and you never know. Like life insurance, like we said in the beginning, it's not just for death. It can protect you and your family in so many ways, especially with living benefits. You want to get that as soon as possible. And so now let's look at myth number 3. My job coverage is enough. Who in here has coverage through their employer? Put a 3 in the chat if your employer has given you coverage. Because for me, I'm not gonna lie, that's all the coverage I used to have when I worked in the hospital because that's all I even really knew. So that's what I had. The thing about that, there's a couple things here. The reality of it, most time employer coverage is only 1 to 2 times your salary. That's not enough to replace your income. Like it replaces your income for 1 year, but if I passed away now, I want my family to have more than 1 year's worth of my income. I need to be thinking, I have a 1 year old. He's not going to be an adult for 17 years. And that's just a legal adult. We know good and well he's not going to be an adult when he's 18 years old. So I need my income to live longer than just 17 for 1 to 2 years. So that's something that usually only happens. Then also, it's not portable. You cannot take this coverage if you leave your employer. It stays with the job. The job owns the policy. And also, when you get older, your coverage reduces over time. That's something most people don't know about. Unfortunately, we had to find out about that real life with my parents. They had great jobs. They were professors. They had, they were with the state. When my dad got to a certain age and they were looking at coverage, they're like, "Oh yes, sir, your coverage is gonna decrease." I don't know if it was half or more, but it was a good chunk. I've had another client, I was talking to her. I think it was her dad, he might have had $1 million. When he got older, they were like, okay, we're bumping him down to $100,000 now of coverage. Excuse me? That's a big difference, especially what your family thought you were covered for. And then some jobs, they don't even include your spouse or your children. You have to pay extra money if you want them on those policies. But like we said, the biggest things, you can't take it with you if you change jobs, if you get laid off, if you retire. It's kind of crazy. But so job insurance is not enough because number one, you don't own that. You want something you own and that you can control. Number four, oh, I'm a stay-at-home parent, or I have a stay-at-home parent, or I know, my spouse is stay-at-home. They don't really need coverage. No paycheck. Just because somebody has no paycheck, it doesn't mean they don't have any financial value in the household. And so typically, if you've read the stats, a stay-at-home parent, everything they do on a daily basis to run that household, that's usually like $100,000 to $120,000 worth of work. So that person is extremely valuable to the household for everything they do. Think about it. They are the child care full time. They get the kids up to school. They go to all the activities. They take them to all the appointments. They prepare all the meals. They go grocery shopping. They cook. They clean. They manage everything, the laundry, the schedules. And they're the emotional support person typically for the household. They do all of those things. That's very, very valuable. And so, just because somebody stay at home doesn't mean they shouldn't have life insurance. They absolutely should, because what they do provides real financial value in that household. Because if they're gone, you're going to have to outsource all of those things um, to somebody else, another company, and it's going to cost a lot of money. So that's number four. Number five, I don't need life insurance. I have savings. How many people have heard somebody say that? I don't need any life insurance. I got savings. Savings is very, very important, but savings alone will not replace your income. It won't cover all the extra expenses, and it will not protect your family's future if you pass away prematurely. So, what it doesn't cover is ongoing expenses. Most people don't have If you have a 30-year mortgage, if you just bought your house, you don't have 30 years worth of your mortgage saved in the bank. That's just not a reality. You don't have utilities for 15, 20 years saved up. There's just a lot of things. Most savings cannot cover your income for years and years and years. Your future goals, children go to college, they have weddings, you want to retire, you want to build generational wealth. Savings alone is not going to cover that. And then you have emergencies. Those are those unexpected bills. What happens when you're living in your home and it's been 7 years and every appliance starts going out? I don't know who that might be, but I've lived it in real life. And so savings alone just it can't do everything. It's just like, wait a minute. So, like I said, even though the appliances are going out, but what if I was really having emergencies? Like, what if there was medical things happening? What if there was debt happening? Well, guess what? When you have different types of coverages, if it's medical related, you're probably going to have living benefits. If it's debt and other things, you might have cash value you now can pull out on top of the savings to take care of emergencies. And so life insurance plus savings is actually the winning combination. So we want to make sure savings handles what's going on today, life insurance protects tomorrow. And together they create true financial security. Just got a few more. And so let's talk about really just look at this living without coverage versus living with coverage, the difference protection can make in a family. Not going to read them all, but you guys can kind of see without coverage, you got the cost of the funeral. You got immediate strain in income, pressure increases of debt and mortgage. Savings can get drained very quickly. Uncertainty. Dreams and plans may be delayed. That's not what you want to happen. Versus really having that peace of mind, knowing everything's covered, knowing that you have protection, knowing your family has time to grieve without financial panic. That is probably one of the biggest ones, guys. It gives you that true peace of mind. And then also creating stability options are preserved and legacy and long-term goals stay protected. And so protection doesn't erase the pain, but it does reduce the pressure. And last, I'm going to talk about, I want to just share really quickly the wealthy use life insurance differently. For many affluent families, life insurance is not just protection, it's a part of the broader wealth strategy. They use this for liquidity, they use this for estate planning, tax advantages, legacy transfer, business planning. And so a lot of people are always like, "Hey, I want to know what this affluent person is doing." Well, here you go. These are some of the tools that they're using to help grow their portfolios, to help create the life that they have, create the peace of mind, get the tax advantages, all of those things. This is one of the things that's in their toolbox. And so it's a mindset shift. Wealthy families do not focus on building wealth, they focus on preserving it, protecting it, and passing it on. It's not just about the building, guys. We got to take it a step further with that. And I want you guys to think about, well, we already talked about this, but I just want you to look at this. You can take a picture if you want to, but how do I know what's the right policy for me? One thing I'll let you know is the great part about it is you can have multiple. I have term with living benefits. I have a cash value policy and I have a final expense policy. That's three because they all serve a different purpose and I would use them at different points in my life. So there's different reasons you're going to need the coverage. It might determine which one somebody would recommend, but you can have more than one. You don't have to just have one. Um, and lastly, today's decisions shape tomorrow's security. So I want you guys to think about it. Protect what matters most, build a stronger tomorrow, leave a lasting impact, and you don't have to do it alone because we're all here to help you prepare. And so, next steps, you guys were invited by a financial professional that would love to help you out to talk about options, to go over what you already have. Best thing I can say for you to do is just ask questions. Just make sure you and your family are good. And so, that's really all I had tonight about life insurance, protecting the bag. But I do want to share with you guys very quickly a part of our series. We're closing out May with the bang. We are closing out May with the bang. We have the one and only Tasha Bay. I call her the estate guru. I'm just letting y'all know. So she is going to be on here talking about build the legacy, talking about wills, trust, and estate planning. It is going to be next Wednesday, 7 p.m. You do not want to miss this. You want to invite your friends and family, somebody, if they own a bank account, if they own a piece of property, they have children. This is what they want to be on because she's going to talk to you about protecting your family, your assets, creating plans that honor your wishes, leaving a legacy. There's a lot more to it. But like I said, she's the expert for me. So Tasha is going to wrap up May with a great webinar. And other than that, too, tomorrow, the wealth room opens up. So what we do here is just talk a little bit more about who we are as professionals, the company that we work with, other services that we can help you guys with. And so we have three of our top gentlemen coming tomorrow to bring the heat and explaining who we are, what we do. Definitely invite you and other guests as well to just hear about us and everything that we do. But like I said, I appreciate all of you for coming on tonight, hearing about protecting the bag and some of the other things we have coming up. But I hope you have a great evening, and I appreciate you all for being here. Good night, everybody.